I don't have yearly forecasts. I tend to give more forecasts relevant to the near-term price activity. And at the moment, I see a key level in euro-dollar at 120, 120. If euro-dollar hits that level, what that means is euro-dollar would have lost half of what it made since the bull market began in 2000. So that will be a very important psychological level, 120, 130. I think that we might hold that level for the short term, but eventually we'll have more euro weakness beneath that level, more likely below the 120 level and even lower. I think that will continue in terms of the timing, second and the third quarter of this year, but I think the moment we hit the month of October, we might start seeing some stability in Europe and some weakness in the US. I mean, all of these event risks, whether it's coming from the US or from Europe, produces event shocks or volatility in the market. And so the key thing is to basically try and use more market timing in the market and be a bit more focused on risk and money management. So from a trading investment perspective, that's what's important. From an economic political perspective, it's very difficult to predict what will happen in the future. So you have to be aware of uncertain events that will happen tomorrow or the next week or the next month. So I think it's basically don't take anything for granted. Know that there is a new normal of unpredictability in the market, increased volatility. So from a trading perspective, market timing is really important, risk and money management. And from the economic political side of things, nothing is certain. So you just have to be aware that we might get some big event shocks in the future. Sure. I mean, volume is key in the equity markets to actually confirm the sustainability of the market move. So that's the key use of volumes, how sustainable that market move will be. I think in FX, of course, it would be very useful, and some of the banks and the brokers see liquidity in their trade flows to maybe see how sustainable the moves are in the market. One of the things that I use and I recommend that people use is COT, Commitment of Trader information, which is printed once a week. It's not a timing or a fast data set, but it is something that can give you an idea of where the money is flowing. And generally speaking in FX, that there are other ways to compensate for the lack of volume data, but if you do want volume data, COT, Commitment of Trader report, I would recommend. Well, ever since the financial crisis began in 2007 officially, we've been experiencing this new normal. This is the famous term that everyone is using, which basically means that the markets have become a lot more volatile. So we're seeing much higher volatility or fat tails, black swan type events happening in the market. And that's affecting not just the long-term picture, but also the short-term intraday trades in the market, where you get a lot of false signals appearing, trends which tend to be a bit more erratic and unpredictable. So it is tougher, I would say, to trade. And in some markets, you're seeing a change in kind of trading psychology in terms of how some of these moves are taking place. Also, away from the market, we're not just seeing difference in market volatility, we're seeing also difference in political and social changes. So this only happens every kind of 10 to 20 years, where we get these kind of big impact in other areas as well as the markets.